have 10 minutes for Q&A by the judges.
One of the first things you guys go into, well, first of all, great presentation. Talking about going into more commercial businesses. And I think from the report, the government side's got better margins.
Right.
How do you expand margins going into lower margin businesses?
The first thing that they always talk about is volume. So with the commercial market, they're currently having about 100,000, 200,000 units produced. With the commercial market, they'll be able to produce a lot more volume, which will cut costs, but they'll also have a drop in price. So they will have a lower margin business, but they will have so much more volume that they will get the top line revenue. So if we go into price elasticity, so one of the things that they really mentioned was, Jack talked about it, they had a 40% drop in price, but they had a 33%, 150% gain in volume, which allowed them to actually have the revenue increase.
So a lot of this has to do with, they talk about it as the semiconductor model. So really there's just one type of wafer that goes into all of their products, or almost all of them, with the exception of the discrete technology. So because they can put that in multiple different products, the batch size that they manufacture them in, as they create more units, there's a very limited variable cost with adding extra units to that batch size.
And one of the reasons their margins are so low in the commercial business is because they're selling to automotive manufacturers, to third parties, and they're selling this at a low price just so they can increase the volume. Moving forward, they're expecting to increase the price, which will increase overall operating margin.
That volume increase you're talking about, is that coming through gaining market share, new markets? Can you talk about how they're going to develop that increase in volume?
Well, they have had great gains in market share. They've expanded government even from 8% 5 years ago to 11% this past year. Their commercial markets went from 74% or 54% of market share of the commercial vision from what was one of their old operating segments to over 60% market share this past year.
But a lot of this going to the new markets. They have conference every year, and where they have people actually pay to come and share ideas with each other. So they have R&D people, people from manufacturers. So a lot of the ideas they come up with are things that FLIR have never thought of before, and so they can actually then market towards those industries. An example of that would be in vets. They use it for thermal imaging to see the inside of the animal because they can't always say what they're, how they're hurt. So they can see with the heat sensors, especially like putting on saddles. The heat was one of the things that they had with the investor day presentation.
You mentioned the growth in non-European export markets. Do you have a sense of the margins of those markets?
In non-European?
The non-European export markets.
Yeah. So they just sold $9 million to United Arab Emirates. They're selling gimbals for some of their helicopters, and it was through the government section, and so those were actually higher than the U.S. government because United Arab Emirates they had to export it through the export license tariff as Jack talked upon, and so it actually was able to get a higher operating margin just for those exports.
Do you have a sense of the export market on the commercial side?
It does limit them a lot, the fact that they are a U.S. manufacturer. They have a cooled and uncooled cores. The uncooled cores are really the only thing that they are allowed to export for cameras with that technology. The cooled cores, they're unable to because of U.S. restrictions. And this has led to them losing market share or losing sales overseas. One of their big competitors, Sofradir, a French company, they're allowed to sell almost all their commercial products directly to Chinese buyers, but FLIR is restricted in that market, so it does hurt them.
So as Jake talked about, our dual-use communications is really what they try to do they have to go through to get to commercialize. And it's not a set standard as in munitions because they have very strict rules. But the dual-use communications are very strict. They're very open and flexible, so they don't know. So they have to approach it and then continuously redo it. So they're always late to market a lot of times too.
On your comp analysis, you guys picked out a bunch of companies, and all your comp analysis was based on, kind of valuation metrics, but there was no growth or margin metrics to compare the other, with the other companies. Did they have similar margins? Did they have as fast growth rates? How did you go about, when you looked and it was all PE and so forth?
Yes, exactly. And so a lot of our Of the 7 companies that we chose, around 5 were specifically said by Fleer to be competitors, and they were specifically chosen because of margins. As you can see on the right-hand side, we have the growth rates for BE Aerospace, and then we have the growth rates for all of other comparables. As you line up, you see that our actual growth rates on an average, weighted average basis hit actually what Fleer is expected to be for consensus estimates.
These are, a lot of these companies are companies that Fleer chose to, or they want people to compare them to. They see a lot of sell-side analysts don't understand that they are really a more commercial company, and that's where they're moving in the future. So they want to be compared to these companies, and we believe largely that most of them are valid.
And so does Fleer generate higher growth rates and margins, and then did that earn them a premium in the valuation?
It depends on which valuation you're looking at, because there are some of the parts where we break down based off the segments. We compared it for the government segment. We had a very low EBITDA, which caused relative to our peers, and so in that valuation we were actually overvalued even more. But when we did to the relative analysis for the market, they were in the 3rd quartile, so they were actually slightly above, but they weren't the highest in the 4th quartile, as you can see from here. It's listing of Fleer's ranking. And so we actually did weight the median and 3rd, so they were almost exactly average. But if we were to weight differently, there's our sensitivity analysis.
How does Fleer's R&D spending compare to their competitors, and do you see that being stable over time or increasing to deal with the heightened competition?
We believe it's going to be stable over time. Their R&D is really the best at the top of the industry. It actually said that if you compare them to pretty much any tech company, they spend, their R&D spend is near the top. They're pretty much without comparison when it comes to R&D spending. We see them as a percentage of revenue, keeping R&D spending right where it's at.
When you say they're near the top, you mean near the top as far as quality of research or amount of resources devoted to R&D?
R&D spend as a percent of revenue.
So total amount. They do have a lot of their R&D is pursuing their own products, so they do a lot of acquisitions to acquire new technology. So an example of this would be the ICX acquisition, where they purchased this technology called CBRNE, and that's a completely new product line, but it actually goes well with the Fleer products. They can merge together to create integrated systems. So as you can see, our percent of revenue that we actually have is 8.5% currently, and if we were to increase that to 10.5%, you can see what happened to our implied price. So if we were to move down around in that spectrum relative to our X multiple.
So yeah, off on ICX, they really see that as what the Indigo was, acquisition was 7 years ago, getting into the commercial vision. But so that's they see CBRNE as the new thermal vision measurement going into the future. That's why they made the acquisition.
And there is no company that they have named in their peer group except for Garmin that spends more on R&D than Fleer as a percentage of revenue.
I think that the acquisition part we haven't touched on a lot, but I think it's a big part of the story going forward. Where do you guys see them going with their acquisitions?
We see them making smaller tuck-in acquisitions, not nearly the size of Raymarine and ICX. Those take up almost half of the total acquisitions that they made in the last 10 years were on those two combined. So in the long run, we see smaller tuck-in acquisitions to really further their new technologies such as SWIR and CBRNE, but we don't see anything major in the future.
So when we met with Mr. Harrison for our group meeting, he talked about this specific company called Access, which is based in Sweden. They're also a thermal imaging company that he would like to potentially acquire, but he says it's a long way off. So he said that they would like to acquire, but they're still looking to, they have to integrate the current ICX and Raymarine. But as you can see, again, we have percentage of revenue for acquisitions going forward. We have it at 4% currently. If you move it down, our implied price goes up. But then you're also thinking about top line revenue and changing that.
If we assume that your projections and your assumptions are wrong, which they probably will be looking back 5 years from now, do you see more upside potential or downside risk to the stock price?
I would say that we see more upside potential to the stock price and downside risk because of their dominant market position, chiefly. The government is the downside, but because they're in the intelligence, surveillance, and reconnaissance space, it's just going to be the space where there will be more spending. When the government DoD slashes 10% spending if they do in the next 5 years, that space won't be as touched as the prime, the big prime projects.
So one of the big things with that is the government spending.
Good job, guys.